Imagine a life where you have enough wealth that every purchase feels effortless, no overthinking, no careful budgeting required. Picture yourself enjoying a peaceful retirement, free from financial worry, while securing a stable and prosperous future for your loved ones. What's the secret to achieving this level of financial freedom? The answer is surprisingly simple: start investing today. In this audiobook summary, we'll uncover key insights from Just Keep Buying by Nick Maggiulli, lessons designed to help you grow your wealth steadily and wisely over time. You'll discover why investing isn't just important, it's absolutely essential. You'll learn where to invest, how to navigate the inevitable ups and downs of the stock market, and how to stay calm during a market crash. And that's only the beginning. We believe that once you complete this summary, you'll feel inspired to take your first step, or your next step, toward becoming a confident, consistent investor. Because when done properly, investing is not merely a strategy, it's a lifetime habit, one that can yield extraordinary results. So what exactly does "just keep buying" mean? It's a philosophy rooted in consistency, the powerful idea of regularly investing into a diversified portfolio, no matter what's happening in the market. Whether the markets are soaring or plummeting, the principle remains the same: keep buying. Much like paying your rent or buying groceries, investing should become an automatic part of your life. It doesn't demand perfect timing or insider knowledge, only discipline and perseverance. And in today's world, investing has never been easier. Thanks to modern platforms, investors now enjoy free trading, low-cost index funds, and broad diversification options. With just a few clicks, you can own shares of some of the world's most successful companies. Don't let fear or uncertainty hold you back. As you'll see throughout this summary, investing is simpler than you might think, and the rewards are far greater than you might imagine. Let's begin this journey toward building lasting wealth and financial security. Chapter 1: Why should you invest? There are 3 compelling reasons why you should start investing today: to save for your future, to protect your money from inflation, and to transform your human capital into financial capital. Let's explore the first reason: saving for your future. One day, you may no longer be able to work, or perhaps you simply won't want to. By starting to invest now, you create a source of income that will support you even after your working years are over. That's true financial independence. Right now, you likely feel strong, capable, and full of energy. It's easy to believe you'll always feel this way. But research reveals an interesting truth: visualizing your future self can be a powerful motivator for saving long-term. In one study, participants were shown digitally aged images of themselves, realistic pictures of what they might look like decades later. Those who saw these future versions of themselves ended up contributing 2% more to their retirement savings compared to those who didn't. Another study asked participants why they save money. The results showed that people who cited retirement or emergency needs as their primary motivation were significantly more likely to save regularly than those saving for short-term goals like buying a house or going on vacation. So remember, saving and investing for your future self is not selfish. It's one of the wisest, most responsible actions you can take today. It's intelligent. You're just investing in your future so that you won't have to rely on anyone else down the line. Now let's discuss the second reason: inflation. Inflation is a silent tax that quietly devours your purchasing power year by year. Whether groceries, education, transportation, or property upkeep, prices keep climbing over time even if your pay remains constant. In the short run, inflation may not be such a big deal, but over time, its effect can be huge. For instance, if the inflation rate is 2% per year, your money will be reduced to half its purchasing power in 35 years. If inflation is 5%, that same reduction occurs in 14 years. The more inflation, the quicker your money devalues. So how do you resist? The solution is investing. By buying assets that appreciate in value over time, you can outpace inflation and keep your wealth. Let's take an example. If you had invested only $1 in long-term U.S. Treasury bonds in 1926, that money would have increased to $200 by the year 2020. But if you had put the same $1 into a diversified portfolio of U.S. stocks, it would have increased to more than $10,000 over the same time. That is the strength of long-term investing. Now picture yourself retired. You're no longer bringing home a paycheck, but the prices of your basic needs continue to rise. If you've been investing throughout, you'll continue to enjoy a steady, passive flow of income to maintain your lifestyle. Lastly, let's discuss the third motivation to invest: converting your human capital to financial capital. Human capital is the value of your time, knowledge, and skill. While you can increase your knowledge and sharpen your skills as time goes by, there is something that you cannot enhance: your time. As time goes by, your energy and ability to work also decrease. You will not be able to accomplish all the things you can do now. Assume that you make $50,000 a year for the next 4 decades, and you save 15% of your income every year consistently with an average return of 6% per annum. With time, not only will you have enough money to satisfy your needs, but the compound interest will make your wealth grow even quicker. Even after retirement, your investments will keep on generating returns for you. If you begin investing now, you can look forward to a stress-free retirement in the future. You will not worry about paying hospital bills, planning for your children's future, or paying everyday expenses. Even as you relax and live comfortably with your loved ones, your money will still be working on your behalf, accumulating in the background, and earning you the liberty you are entitled to. What do you invest in? Having discussed why you should invest, the big follow-up question is, where do you invest? You've likely seen loads of investment gurus on YouTube or read books promising to take you down the one right road to riches. Here's the reality. There isn't a one-size-fits-all approach to getting rich. There are numerous ways to accumulate wealth. What is right for another may not be for you. That's why it's key to learn about various methods and find out what is appropriate for your own situation. The end result should be a diversified asset base of income-generating property, and that's precisely what the title, "Just Keep Buying," represents. Continue to invest regularly into a combination of assets in the long term. So what investments are worth considering? Let's go through some broad asset classes that can assist you in accumulating wealth. We'll discuss the advantages and disadvantages of each and how to invest in them. However, prior to making any choice, make sure that you know about every asset in depth. We'll start with stocks, or equities. When you purchase stocks, you're purchasing ownership in a business. Stocks are among the most dependable long-term wealth-building tools. Researchers examined the long-term stock market returns of 16 nations between 1900 and February 2006. In spite of significant world events such as 2 world wars and the Great Depression, each of these nations provided positive long-term returns. For example, Sweden returned an average of 8% per year. The US was at 6.8%, and even the lowest, Belgium, was at 2.7%. Another benefit of stocks is that they need no maintenance. After you purchase them, you don't need to take care of them yourself, yet they can keep making returns for you. Stocks do, however, have one downside: volatility. Historically, stock prices have fallen by 50% approximately twice in each 100 years, by 30% every 4 years, and by 10% nearly every other year. These fluctuations may be frustrating, particularly for beginners. But the trick lies in looking at the long term. History proves that with time, the prices of stocks bounce back and expand, even during great crises. Time, in this instance, is your friend. How then do you purchase stocks? You can inquire from your bank or register with a good online stockbroker. You can buy individual stocks, or you can buy through exchange-traded funds, ETFs, or index funds. Index funds are suggested by the author, Nick Maggiulli, as they enable you to invest in many companies quickly and inexpensively. For instance, investing in an S&P 500 index fund provides exposure to the 500 best companies in the United States. A total world index fund, however, allows you to venture into top-performing stocks of the world. As a shareholder, you can gain dividends, your portion of a firm's profits, in addition to capital gains. Now, let's discuss bonds. Purchasing a bond basically involves lending an entity, either the government or a company, money for a specific amount of time. As repayment, they pay you interest, called a coupon, until your maturity date when your principal is repaid. The yield on a bond is determined by dividing the yearly coupon payment by the cost of the bond. For instance, if you purchase a bond for $1,000 and get paid $100 a year, the yield is 10%. When most books discuss bonds, they're referring to U.S. Treasury bonds, but there are numerous other varieties: municipal bonds, loans to municipalities, corporate bonds, loans to corporations, and foreign government bonds. Non-U.S. bonds tend to pay higher interest rates, but they're riskier too. Why? Because unlike the U.S. government, which can just print money to settle its debt, other corporations or governments can default on payment during bad times. Since bond returns are usually lower than stock returns, they serve as a diversifying asset. They help balance risk. While they may offer modest returns, bonds are relatively safe and aren't as affected by market swings as stocks. Another reason to include bonds in your portfolio is their consistency. Even when riskier assets are down, bonds tend to provide stable returns. You can also liquidate them as a source of cash. For example, if the stock market crashes and you lose your job, having bonds means that you can cash them out in cash without a big loss. But if you have all your money in high-risk assets, you might get in big trouble. We experienced it in the COVID-19 pandemic. Picture 3 different portfolios, one with S&P 500 stocks only, another with 80% stocks and 20% bonds, and a third with 60% stocks and 40% bonds. When markets bottomed out in March 2020, the all-stock portfolio was hit the hardest. The 60-40 combination, however, fared better because of its bond component. In summary, despite their reduced returns, bonds can serve as a cushion during times of crisis. You may purchase individual bonds directly, but the author recommends buying bond ETFs or index funds for convenience and diversification. You can find these choices through your bank or a reliable online brokerage. Now let's discuss real estate. Property investing can be a great wealth-creating step. You can rent it out, having the tenant subsidize the mortgage while you reap the long-term appreciation of property. If you borrow to invest in property, that's leverage. For instance, with $100,000, you can purchase a $500,000 property by financing the other $400,000. If the value of the property increases to $600,000, you can sell it, pay back your loan, and still have a $200,000 profit, doubling your initial investment. Leverage, however, can cut both ways. If the value of the property falls to $400,000 and you sell it, you lose your initial $100,000 investment. Luckily, such huge crashes are infrequent, and in the long run, real estate tends to appreciate. That's why most investors employ leverage to their benefit. Now let's discuss the negatives. As a landlord, you will have to deal with tenants, fix the property, and potentially put it on websites such as Airbnb. While real estate can provide higher returns than bonds or stocks, it also requires more work. It's not a diversified asset. You're accepting concentrated risk. If your real estate faces problems or a crisis such as the COVID-19 pandemic strikes, you may lose heavily. Nevertheless, if you want more autonomy and real ownership, real estate could be the way to go for you. Just ensure you do your research well, seek advice from experts, and be ready for the technical and legalities that come with it. Now, let's discuss REITs, real estate investment trusts. REITs enable you to invest in real estate without having to deal with properties yourself. These are corporations that own and manage income-producing real estate. As an investor, you receive dividends from their earnings. Under law, REITs are mandated to distribute 90% of their earnings as dividends. There are various forms of REITs. Residential REITs own houses, apartments, student housing, and so forth. Commercial REITs target office buildings, retail, and warehouses. REITs may be publicly traded, private, or non-traded public. Private REITs are only sold to accredited investors, or individuals with a net worth in excess of $1 million. Public, non-traded REITs are not traded on stock exchanges, but can be accessed through crowdfunding websites. Publicly traded REITs are available to anyone and can be purchased similar to stocks. Rather than purchasing individual REITs, the author advises purchasing REIT index funds, which provide more diversification. REITs tend to prosper in good times and even outperform stocks. But when a market crash occurs, they plummet just as severely. That's why it's not really a diversification tool but a riskier asset. Let's now compare these income-generating assets. Stocks provide 8% to 10% average annual compounded returns. Bonds usually provide 2% to 4%. Real estate may return 12% to 15%. REITs usually return 10% to 12%. Other investments include small businesses, franchises, or angel investing, which can yield 20% to 25% annual returns with high growth potential. Agricultural land provides 7% to 9% and serves as a good hedge against inflation. Royalties provide relatively consistent returns of 5% to 20%. Cryptocurrencies, gold, and art don't yield solid income and are extremely speculative. They might or might not be appropriate based on your risk level. Why you shouldn't invest in individual stocks. There are two good reasons why you should not invest in individual stocks. One is monetary, and the other is existence. Let us begin with the monetary argument. Even the finest professional investors on the planet, with full-time analysts and top-notch research software, always tend to underperform index funds such as the S&P 500. So if they can't outperform the market, what odds are there that you, the individual investor, will? Studies indicate that almost 75% of actively managed funds don't beat their benchmark over a 5-year time frame. They have highly trained staff behind them, but they still lag behind. If the experts can't consistently select winning stocks, then it's not likely that amateur investors will be able to do better. Additional studies indicate that only a small fraction of individual stocks do well over the long term. One study titled, "Do Stocks Outperform Treasury Bills?" discovered that from 1926 to February 2016, only the top 4% of U.S. stocks were accountable for all the market's outperformance relative to Treasury bills. That implies 96% of stocks underperformed or did not produce any significant return. So ask yourself this. What are the chances that you'll choose a stock from the successful 4% instead of the failing 96%? To put it in an even more sobering perspective, take a look at the Dow Jones Industrial Average from 1920. None of the 20 companies represented in the index at the time are included in it today. Even the largest, most thriving corporations don't remain at the top indefinitely. Choosing the correct stock is much harder than it appears. Beating the market is a feat that few achieve, even for the best investors. The odds are against you, and the likelihood of losing money is great. That is why having a low-cost index fund or ETF is usually a better option. Not only does it minimize your stress, but it also decreases the likelihood of substantial financial loss. Index funds distribute your risk among hundreds of businesses, providing more stability and consistent return in the long run. Now let's turn to the argument about existence. This argument challenges your ability and confidence as an investor. How do you actually know if you're good at selecting individual stocks? Is one good trade for a day, a week, or a year evidence that you're a smart investor? Likely not. Indeed, it may take years to realize if your choice was skill or plain luck. Even then, you'll need to wait and look at your performance compared to an index such as the S&P 500 to determine whether you actually fared better. And consider another hurdle. What if your outperformance is not because of your analysis, but because of something outside your control? Imagine a stock you selected goes up astronomically, not because you noticed something everyone else didn't, but just because it became popular on social media. Would that be a skill anymore? Let's say you're a professional investor running a mutual fund. Based on studies, even professionals will underperform their benchmark over a 3-year span. And when that occurs, they're left to wonder, was it just a slump, or have they lost their edge forever? That's the problem of existence. It's stressful and emotionally taxing. Trying to analyze each individual stock, keep up with the market, and constantly measure your returns can turn into a grueling full-time job. Even worse, a single decline in a stock can erase a great percentage of your investment within a matter of hours. Now, naturally, we require stock pickers. Active investors and analysts do create value. They facilitate setting prices and make markets efficient. But for most average investors, there is a better alternative. Investing in ETFs and index funds allows you to steer clear of unnecessary anxiety and minimize the risk of losing your hard-earned cash. You don't have to second-guess which stock will be the winner. You just continue to buy a chunk of the whole market. It's not merely a safer tactic. It's a wiser one. How quickly should you invest? Let's put a little sunshine into the picture with some good news. Did you know that the stock market goes up more times than it goes down? Indeed, during the 20th century, the Dow Jones Industrial Average increased from a mere 66 points to more than 11,497. And this expansion did not occur during times of peace. It occurred during the time the world experienced two global wars, the Great Depression, over a dozen recessions, oil shocks, an influenza epidemic, and even the resignation of an incumbent U.S. president. And this trend is not exclusive to the U.S. market alone. As we witnessed previously, world equity markets also registered positive long-term trends across the decades even with facing various challenges. Therefore, if probability is in your side, then why delay? Each passing day you hesitate, you miss the opportunity for your money to accrue. The earlier you start, the better you allow time for your investment to multiply and compound. Do not, therefore, wait for the opportune time. Just begin. Now pretend that you acquire a sudden $1 million, and your task is to make it grow incrementally for the next century. You have two choices. You can invest all of the $1 million immediately or invest 1% of it, i.e., $10,000, every year for the next 100 years. Which plan makes sense? From the perspective of long-term growth, the best option would be to put all $1 million in one go. Why? Because the sooner you invest, the longer your money gets to grow. If you put it all in over 100 years, yes, shares might go up, but the rest of the cash just sitting there will erode slowly from inflation. Of course, investing all your money in the stock market at once might sound dangerous, but you can decrease that risk by creating a diversified portfolio, say 60% stocks and 40% bonds. That way, you continue to make your money work while keeping yourself safe from significant losses. Actually, a 60-40 portfolio can perform better than an investment strategy in which you put $10,000 into stocks annually, although that strategy is 100% invested in equities. That's the strength of time and intelligent asset allocation. Now perhaps you don't have $1 million just sitting around, and that's alright. What is important is this: the stock market tends to go up in the long run. So the perfect time to invest isn't at some point. It's today. By starting early, not only do you provide your money with more time to grow, but you also protect it from the creeping slow poison of inflation. And above all, you take concrete steps towards creating a secure and peaceful retirement. So don't wait for the planets to align. Just continue to buy. Begin today. Why? You should not be afraid of volatility. Here's another investing tip that might shock you. The greatest risk is actually not taking any risk at all. If you're scared of stock prices going down and don't invest because of fear, you'll miss one of the best chances to make your money grow. To be a successful long-term investor, you need to learn to embrace volatility, market unpredictability, and the inevitable ups and downs along the way. Let's look at a thought experiment. Suppose there's a genie that materializes at the end of every year and informs you about how much the US stock market would decline at its lowest level the following year. Now this genie will not tell you what specific stocks to buy or what the overall market is going to do, but it can tell you the highest intra-year drawdown, i.e., the greatest fall from the peak to trough in a particular year. Here is the question. At what stage would you go out of stocks and come into bonds? What if the genie tells you that the market may fall 40% next year? Would you still invest? What about a 20% fall? What's your own tolerance? Before you reply, some context that might help is that from 1950 to 2020, the average largest intra-year decline in the S&P 500 was approximately 13.7%. The worst yearly decline occurred during November 2008 when the index declined by almost 48%. Now, let's visit some possible situations. Scenario 1, assume that you are an extremely conservative investor. You instruct the genie not to invest in the stock in any year the market is anticipated to decline by more than 5%. Such a strategy is called avoid the drawdown. Here, you'd shift all your money into bonds in those wild years. But if you'd done this from 1950 through 2020, you'd have had 90% less wealth than someone who had just stuck with a buy and hold philosophy, remaining invested in stocks through it all regardless of ups and downs. Why? Because markets have 5% declines nearly every year. Indeed, there were but 7 years out of the whole 70-year period when the drawdown was below 5%. So by not taking risk, you would also not have captured most of the growth in the stock market. Scenario 2. Suppose now that you only miss years when the market is likely to decline by greater than 40%. You would then have only sold out in February 2008. And indeed, this strategy would beat buy and hold slightly, but the improvement would be small. And we can see the two extremes here. Staying out of all volatility means enormous underperformance, whereas attempting to avoid just extreme crashes has hardly any benefit. So that leaves a middle way. Never invest in the stock market during those years when the anticipated drawdown is above 15%. In those cases, you would move to bonds during highly volatile years and go into stocks the rest of the time. This approach provides a fair balance between reducing risk and maximizing long-term wealth. Under this plan, you'd be out of the stock market roughly 1/3 of the time, but only in years when there's high volatility. But if you shrink your tolerance to 20% or 30% drawdowns, you'll find yourself remaining in the market during its worst times and losing money rather than making it. Now the catch. There is no genie. There's no method of knowing for sure what future drawdowns will be. You never know in advance if the market will go down 5%, 15%, or 40%. And since the future volatility can't be forecasted, there's just one thing you can do: diversify your portfolio. Investing in a variety of asset classes, stocks, bonds, property, and more helps to insulate you from the volatile behavior of the market. Diversification will not prevent volatility, but it can enable you to handle it and remain invested with confidence. And above all, accept that volatility is part of the game. If you can't remain calm when the market falls by 50%, something that historically occurs roughly once per century, then maybe investing is not for you. But if you can hold on, that's how you win the long game. Because in the investing world, fear is costly, and patience is a superpower. How to invest in a crisis. The COVID-19 pandemic shook the entire world, and the financial markets were no exception. On March 2020, the S&P 500 index was down 33% from its recent peak. If you were an investor then, what would you have done? Would you have panicked and sold your shares, or would you have stood firm, keeping your cool amidst lockdowns, business shutdowns, and paralyzing uncertainty? A famous quote from Baron Rothschild, a banker of the 18th century, provides food for thought. He said, "The time to invest is when there's blood in the streets." Rothschild accumulated his fortune during the turmoil of the Battle of Waterloo when everybody else was running for cover. His philosophy is still valid today. When the prices are low and fear is high, that's when the opportunity is most. If you invest when the market crashes, your investments will grow exponentially as the market rebounds. Let's use a historical example. Assume that you had put $100 per month into the U.S. stock market between September of 1929 and November of 1936, a time frame including the notorious 1929 crash and the following recovery. Statistics indicate that every $100 you had put in would have increased by November 1936, but the strongest returns would have been achieved from the money put in during the bottom of the crash, in the summer of 1932. That $100 investment alone would have increased to $440 by late 1936. That's more than 4 times the original value, and this sort of explosive growth during a recovery isn't unusual. In fact, most market crashes can bring 50% to 100% returns in the ensuing recovery. Why is this the case? It's a handy but strong math fact. Regaining a loss needs a very large percentage return. To come back from a 10% loss, for instance, you must have a 11.1 gain. A 20% loss means you need to have a 25% gain. A 50% loss, you require a 100% gain to break even. If you graphed this relationship, it would be an exponential curve showing how deep losses necessitate even deeper gains to recover. Take March 23, 2020. Once more, the S&P 500 fell 33%. By the math, it required a 50% gain to get back to its prior high, and it did just that. Within 6 months, those who had the guts to invest during that crash had their money increase by 50% within 6 months. Need more evidence? Let's examine statistics from each time the market declined by 30% or worse between 1920 and 2020. If you had invested in those drawdown months, your odds of averaging less than 5% per year were less than 10%. More than half the time, you would have earned over 10% annualized returns. Now here's the kicker. If the market had fallen by 50% and you invested then, your chances of making more than 25% annual returns were better than 50%. That is, don't be scared of market crashes. They usually provide the best moments to invest and increase your wealth. Historically speaking, markets recover fully within a few years at worst, or a decade at best. Still skeptical? A study of 39 countries between 1814 and 2019 found that the likelihood of inflation overpowering long-term stock market returns was just 12%. That is, there is only 1 in 8 chance that inflation would outperform your investment returns over 30 years. Now let's consider one final view. You may ask yourself, what if I invest at the worst possible time? Consider the Japanese stock market, for instance. Had you put in a lump sum at its height in December of 1989, you could still be losing money years later. But what if, instead, you'd put in $1 each day from 1980 through 2020? Even through the crashes and lost decades, you would have gained a modest positive return. That's the power of being consistent. This is the power of just keep buying. So the question is, will you sit on the sidelines frozen by fear whenever there's a crash? Or will you act, investing when others are afraid and put yourself in position for huge gains? Because the reality is, those who invest during a crisis don't just make it through. They create real wealth. Eventually, the stock prices will rise 25%, 50%, perhaps even 100%. The only question is, will you still be waiting or will you already be well on your way to being wealthy? How do you know when to sell? This book urges you to simply continue buying, to buy regularly and repeatedly. But sooner or later, there will be the need to sell, and that is one of the toughest calls in investing. Why? Because your emotions will try to make you hold on a bit longer in the hopes of even greater returns, or they'll push you to sell outright in order to cut losses. To keep from falling into that emotional trap, you must be clear about one thing. Never sell on impulse. Instead, sell for concrete reasons, either to rebalance your portfolio, to get out of a concentrated position, or to meet a financial requirement. Beyond the 3 reasons mentioned above, do not sell only to avoid paying taxes or pursue timing the market. Prior to explaining these scenarios, let us keep this in mind. Sell when the time is right and not in hurry. As we have learned above, the market takes its dips less frequently than it goes up. Even if you are to sell after decades, the chances are the investment will have increased. But if you sell too soon, you could end up missing the next big uptrend. That's why the intelligent thing to do is to buy now and sell incrementally in a manner that optimizes your long-term wealth. Let's begin with the first case, selling to rebalance your portfolio. When you begin investing, you typically establish a target allocation. For instance, 60% in US stocks and 40% in US bonds. If you have $1,000, that means $600 in stocks and $400 in bonds. But over time, your higher return assets, like stocks, will begin to dominate your portfolio. If you never rebalance, your asset mix can drift far from your original plan. For example, had you put in $1,000 in 1930 and not touched it for 30 years, your holdings would have swung by 1960 from 60-40 to perhaps between 75% and 95% stock. But had you rebalanced each year, your proportions would still have hovered around 60% stocks, 40% bonds. That's because stocks outperform bonds over time, and rebalancing enables you to gradually lock in those gains by moving some profits into safer assets. Yes. The never rebalance strategy may outperform slightly because it has more stock exposure, but intelligent investors rebalance to manage risk. Rebalancing is not intended to generate maximum returns. It's to guard against unwanted volatility. Without it, your portfolio might turn into something far riskier than what you originally intended. Annual rebalancing is often the most practical way to go. You only need to do it once a year, which translates to less vigilance and more calm. Attempting to rebalance each time your stock allocation reaches 70% or falls to 50% can be an undue strain and an inefficient process. You can also rebalance at tax time, cashing out winners and dealing with capital gains taxes in one session. This strategy is time and effort saving. However, excessive rebalancing will result in more taxes and might even cut down your wealth in the long run. There is another way to rebalance without selling. The author prefers this method. Rather than selling your winners, just purchase additional units of the underperforming asset. For instance, if your portfolio veers to 70% stocks and 30% bonds, you can correct the imbalance not by selling stocks, but by purchasing additional bonds until your mix gets back to 60-40. This spares you capital gains taxes and keeps you continuing to invest on a regular basis, particularly helpful during bear markets when purchasing additional can be most beneficial. Yet this is most effective for investors in the accumulation phase. If your portfolio is already quite large, buying more may not be an option. In this situation, selling to rebalance will be required, but attempt to limit how frequently you sell to prevent unnecessary tax expenses. Now let's discuss the second reason to sell, which is closing out a concentrated position. This is when you have a large amount of your wealth invested in one asset or stock. For instance, if you are employed with a company providing equity compensation, in the course of time, you may end up having much of your net worth tied up in that particular stock. That is not bad until it becomes so. With your position expanding, it's best to begin selling small slices to minimize your risk. How much you sell depends on what you want to do. If you have a mortgage and most of your money is in corporate stock, you could sell part of the stock to retire the mortgage. Sure, that stock may appreciate more than the value of your house, but that's only potential. Your mortgage is an obligation. You might sell 10% monthly or sell off 50% in one batch and keep the rest. Whatever you prefer. But there's one rule. Don't sell it all together. Big sales can bring massive tax implications, and you would regret it if the stock price goes up in the future. That being said, keep this in mind. Stocks tend to underperform indexes, such as the S&P 500 over the long run. So, ask yourself, how much risk are you willing to take? And from that, make your selling plan. Lastly, let's talk about the third reason to sell, to live your life. Whether it's funding a comfortable retirement or taking a summer vacation, paying for your children's education, or covering your family's health care, spending your money isn't a bad thing. The author highlights a phenomenon known as diminishing marginal utility. This is a fancy way of saying that the more of something you have, the less worthwhile each succeeding unit is. For example, increasing your wealth from $0 to $1 million brings much more happiness than increasing it from $1 million to $2 million. Once your family's needs are taken care of, additional luxury doesn't add much joy. But providing your loved ones with experiences that mean something, that's priceless. So, yes, selling is not failure. It's part of the game. The true goal of investing is not merely to increase your net worth. It's to create the life you've always imagined living. Conclusion. Let's summarize what we've learned in this compelling odyssey through Just Keep Buying very quickly. First, you learned why investing is crucial. In order to save for retirement, to shield your money from inflation, and to transform your human capital, your time, effort, and ability into financial capital that works for you even if you cannot work any longer. Second, you get familiar with various assets such as stocks, bonds, real estate, and RI. Every asset class has its own risks and rewards. That's why you need to create a diversified portfolio, one that not only increases your wealth, but also helps you to control risk. Third, you learned why you shouldn't invest in individual stocks. It's extremely hard to pick winners, even for professionals. Rather than trying to chase performance, invest in low-cost index funds or ETFs, and let the market do the work for you. Fourth, you learned that the best time to start is as early as you can. Each day that you put it off is a day that your money isn't growing. So in order to beat inflation and grow wealth, invest now. Fifth, you learned you don't need to be afraid of market volatility. Aiming to time the market or avoiding it when it's sliding only makes you lose out on good opportunities. Instead, concentrate on developing a diversified portfolio and remain invested for the long term. Sixth, you saw how strong it is to keep purchasing even during a crisis. Yes, slumps can be frightening. But the majority of stock markets rebound within a couple of years, sometimes even quicker. And because each percentage point of loss will take an even greater percentage of gain to erase, purchasing at crashes often produces the greatest reward. That is, crisis creates opportunity. Last, you learned when to sell. Let your head, not your heart, make your decisions. Only sell to rebalance your portfolio, to close out a concentrated position, or to meet critical financial needs. Selling for the right reasons and at the right time keeps you on course while avoiding unnecessary taxes and stress. Each day, we make financial decisions, without knowing what the future holds. We have no magic lamp. We have no time machine. But what we do have are ageless principles that you've just heard within this overview. If you use these basic guidelines, you'll be well on your way to long-term financial success. Yes, you can become rich. But it all starts with one decision. Start investing as soon as possible. So no matter where you're beginning from, no matter what's going on in the world, just keep buying.